You probably think you need thousands or even lakhs of rupees to start investing. You might think that stock market is only for people who understand complicated charts, financial statements, and economics. But, or maybe you are wrong. You have thought, I will start investing once I start earning properly. This is the right mindset, but here is the problem. Waiting until you have a lot of money to learn about investing can mean losing years of valuable experience. And because investing isn't about becoming rich overnight, yes, it's about learning how to make your money work for your future. So, in this video, I am going to take you from zero knowledge to understanding the basics of investing. We will talk about stocks, we will talk about mutual funds, you will talk about SIPs, index funds, risk, compounding, and most importantly, how to complete beginner can actually get started. Let's start the video. What is investing? Let's start with the most basic question. What exactly is investing? In simple words, investing means putting your money into an asset with the expectation that it may grow in value or generate income over time. For example, imagine you have 10,000 rupees. You could simply keep that money aside, or depending on your goals and risk tolerance, you could put some of it into an investment that has the potential to grow over the long term. But here is the most important thing: investment returns are not guaranteed. Your investment can go up, it can also go down. That's why investing is different from simply keeping money in a saving accounts or taking some level of risk in exchange for the possibility of higher long-term returns. And this gives us our first rule. Never invest in something you don't understand. Yes, the second is saving versus investing. Before we talk about stocks and mutual funds, let's understand the difference between saving and investing. Saving is generally about keeping money available for your short term purposes and needs and emergency. Investing is generally about putting money into an asset or for potential long-term growth. For example, let's say you know that you will need 20,000 rupees for an important expense in the next few months. That isn't money. You should blindly put into a risky investment. Why? Because what happens if the market falls right when you need the money? You might be forced to sell at a loss. So, before investing, make sure you are not sacrificing your financial needs just to enter the market. Because investing should be part of your financial plan, not your entire financial plan. Let's move to third. How much money do you need to start? Yes, now let's answer one of the biggest beginner questions. How much money do I need to start investing? Do you need 1 lakh? Do you need 50,000 or 10,000? Not necessarily. Yes, depending on the investment and platform, you may be able to start with a relatively small amount. Yes, you heard right. For example, some people start investing by 500 or 1000 regularly. But here's what I want you to understand: that the amount of money you start with is not the most important thing. Your knowledge and habits are. If you invest 1000 without understanding what you are doing, that 1000 isn't going to teach you much. But if you use that experience to understand how investing works, you are building something much more valuable. Why I am saying that? Because you are building financial knowledge. So don't focus only on how much money can I make from the market. Start asking how much can I learn. Let's move to the fourth one. What is the stock? Now let's talk about the stock market. Imagine there is a company. That company needs capital to grow its business. One way companies can raise capital is by issuing shares. A share represents a small ownership interest in a company. So when you buy a company share, you are buying a tiny piece of that business. For example, if you buy shares of a listed company, you become a shareholder of that company and you became a small stakeholder. And obviously, if you own one share, you are not going to walk into CEO's office and start giving instruction. Yes, your ownership is tiny, but technically you do own a small portion of that company, and the value of that share can rise or fall depending on many factors, including the company's performance, market conditions, investor expectations, and overall sentiment. Let's move to the footnote. How do you make money from stocks? There are generally two ways people may benefit from owning stocks. Yes, the first is capital appreciation. Let's say you buy a share for 100 rupees. Later, the market price becomes 130. If you sell at that price, you have a 30 gain before considering applicable cost and taxes. But remember, the opposite can happen. If that share falls from 100 to 70, you are sitting on a 30 loss. If you sell at that price, the second potential source of income is dividends. Some companies distribute part of their profit to shareholders, but not every company pays dividends, and that dividends should not be treated as guaranteed income. So when you buy a stock, you are taking risk. Let's move to the sixth one. What is a mutual fund? Now let's move to something many beginners hear about: mutual funds. Imagine you want to invest in multiple companies. You could research and buy and each stock individually. But that requires time, knowledge, and ongoing research. Mutual funds works differently. Yes, money from many investors is pooled together and invested according to the fund's stated objective and strategy. Depending on the fund, it may invest in stocks, bonds, or other securities. One major benefit can diversification instead of depending entirely on one company. Your money may be spread across many investments, but don't make this mistake. Mutual funds are not risk free. Yes, the value can still rise and still fall. So before you investing in a mutual fund, understand what it invests in, its risk, fees, and objectives. Let's move to the seventh one. What is an SIP? Now you have probably heard this word everywhere. I hope that you have heard this word because SIP stands for Systematic Investment Plan. In simple terms, it allows you to invest a fixed amount into a mutual fund at regular intervals. For example, 500 every month of 1000 every month instead of trying to figure out the perfect time to invest a large amount you are investing regularly. According to your plan, sorry, but according to your plan, here is something important. SIP is a method of investing, not a separate investment product. The mutual fund you are investing into still has market risk, and SIP does not guarantee profits. The bigger advantage for many investors is that it can create consistency and discipline. Think about it like going to the gym. You don't expect to become fit after one workout. You build results through consistency over time. Investing can work in a similar way. Now let's talk about index funds. An index fund is designed to represent a particular group of securities or part of the market. An index fund generally tries to track a particular index rather than actively selecting individual stocks to beat the market. For example, instead of trying to identify that one company that will perform the best, an investor can get exposure to a broader group through an index tracking investment. This can provide diversification, but remember, diversification reduces concentration risk. It does not eliminate market risk. If the overall market falls, an index fund can fall too. Now we come to the one of the most important concept in investing, compounding. Yes, here is the simple idea. You invest in money, that investment generates return. Yes, if those returns stay invested, future growth can happen on a large amount. So your previous gains can become part of the base that generates future gains. That's compounding. And that is why time matters so much. You don't necessarily need to start with a huge amount of money. You need to understand the process and give your investments enough time to potentially grow. But don't misunderstand this, that compounding doesn't mean your investment will grow smoothly every year. Real markets go up and down. There can be bad years also. Can be market crashes. There can be periods where your investment loses value. Long-term investing doesn't eliminate these risks. It means you are planning around them rather than expecting every year to be positive. Now let's talk about the part most of beginners actually want to know. Okay, I understand investing, but what should I actually invest in? Before choosing an investment, ask yourself four questions. Yes, only four questions. Question number one: what is my goal? Are you investing for 5 years or 10 years or after retirement or education or future business? Your goal matters, yes. The question number two is what is my time horizon? Yes. How long can you leave the money invested? Questions number three. Yes. Question number three is about how much risk can I handle? Imagine your investment falls 20%. Would you panic and sell immediately? No, not at all. Understanding your risk tolerance is important. Question number four, and the last question is: do I actually understand what I am buying? If you can't explain what your investment is and why you own it, you probably shouldn't be buying it yet. Move to the next one. Don't chase the multi-bigger. Yes, this is where beginners get into trouble. You open Instagram, you see a reel saying this stock will give 10x returns. You get excited, you buy it, and then the stock falls. Suddenly, you are asking yourself that what happened? The problem was not necessarily the market. The problem was that you invested on someone else's prediction instead of understanding the investment yourself. That's why the investment knowledge is most important thing. There is nothing wrong with the learning from financial creators, but there is a huge difference between learning from someone and blindly copying someone. Never confuse confidence with knowledge. Yes, and be extremely cautious when someone promises guaranteed or unusually high returns with little or no risk. And now let's move to the next point, 5 mistakes beginners should avoid. Let's quickly go through the 5 common mistakes. Number 1 is investing without understanding. If you don't understand it, don't buy it. Simple. Number 2, trying to get rich quickly. Investing isn't a lottery ticket. Yes, there is a big psychology behind it, but we will move to the next mistake, putting everything into one investment. Concentration can increase your risk. Yes. Number 4 is panic selling. Markets can fall. Don't make emotional decisions. Yes. Without considering your plan. And number 5 is following social media tips blindly. Use social media to learn. Don't let a random post control your money. Now let's move to the next one, your simpler beginner roadmap. So what as a beginner we can do? So if you are starting from absolute zero, here's a simple roadmap. Step 1, learn the basics. Yes, understand stocks, mutual funds, index funds, SIPs, risk, diversification and compounding. Step 2, build your financial foundation. Don't invest money that you need for essential expenses. Step 3, set your goals. Yes, know why you are investing. Step 4, understand your risk tolerance. Know how much volatility you can realistically handle. Step 5, research your investment. Understand what you are buying and why, because it's gonna help you a lot in the future. Step 6, start appropriately. You don't need to make a massive investment just to prove that you are serious. Step 7, stay consistent and keep learning. Don't let every market movement change your entire strategy. And it is all about the strategy. So, if you are a complete beginner, here is what I want you to remember. You don't need to be rich to start learning about investing or trading. You don't need to be predict the next big stock. Yes, you don't need to check the market every 5 minutes. And you definitely don't need to follow every finance influencer on the internet. There is a difference between following every finance influencer and follow such quality finance influencer. So start with the knowledge, understand risk, set your goals, choose investments carefully, and give your money time, because investing isn't about asking, how can I double my money tomorrow? It's not a whole night process. It's about asking, how can I make better financial decisions for the next 5 to 10 or 20 years? That's the mindset that matters. If this video helped you understand investing from the beginning, make sure to like this video and subscribe to this channel, and comment investing if you want the next video to be about how to research your first stock as a beginner. Okay, so I will see you in the next video. Keep learning and keep improving yourself and keep building